So, how in the world does one company outperform the market by over 5 million percent? It sounds impossible, right? Well, today we're going to pop the hood and reverse engineer the architecture of one of history's greatest wealth machines, Warren Buffett's Berkshire Hathaway. First, just look at this number. No, it's not a typo. That is 5.5 million percent. It's the total return of Berkshire Hathaway since 1965. A number so outrageously big, it's honestly hard to even wrap your head around. And when you put it next to the S&P 500's return over the same time, well, the comparison is just ridiculous. This isn't just beating the market. This is playing a completely different game on a different planet. So what's the secret sauce? How did he possibly pull this off? Okay, to really get it, we've got to look at the blueprints. We're going to walk through the 4 major phases of his strategy, then look at the secret engine that powered it all, and finally, get into the massive challenge his own incredible success has created. All right, let's start at the beginning. It all kicked off with a surprisingly simple, almost gritty idea that he picked up from his mentor, the legend himself, Benjamin Graham. You could say this was the original source code for the entire Berkshire operating system. Graham's whole philosophy was called cigar butt investing, and the name is perfect. Imagine you're walking down the street and you find a soggy, nasty-looking cigar butt on the ground. But it has one good puff left in it. It's not glamorous, it's kind of gross, but hey, it's a free puff. In investing, that meant finding a terrible, dying company that was selling for less than the cash it had in the bank. And this was totally a numbers game. It was a mechanical process. Just look at the criteria here. You're buying $1 of assets for 50, 60 cents. You didn't need to know anything about the products, the management, or the future. No, it was just cold, hard, disciplined math. But here's the thing about cigar butt investing. It has a huge flaw. It just doesn't scale. You can't invest billions of dollars buying up tiny, failing companies. For Berkshire to become the giant it is today, Buffett had to make a massive intellectual pivot. And that change was sparked by a couple of key people. The real catalyst was his longtime partner, Charlie Munger. Munger basically looked at Buffett and told him to stop picking up those gross, soggy cigar butts. This quote right here sums up the revolution in thinking. Munger's point was simple but profound. Why buy a terrible business for a cheap price when you can buy a wonderful business for a fair price and let it grow for decades? And you can see just how big of a change this was. Graham was all about the balance sheet, what a company owns. Munger and another big influence, Philip Fisher, were all about the income statement, what a company earns. The entire goal just flipped on its head, from buy cheap to buy good. This new philosophy gave birth to Buffett's most famous concept, the economic moat. He started searching for businesses that were like impenetrable castles, protected by a wide moat. Think about Coca-Cola's brand, that's a moat. Or a railroad's tracks that no one else can build, that's a moat. It's all about a durable advantage that keeps competitors away and the profits safely inside. Okay, so now Buffett has the philosophy locked in. But a great philosophy alone doesn't get you to 5 million percent. He needed rocket fuel. And he found it in a place most people think is pretty boring, the insurance industry. This became Berkshire's secret weapon. So think about this. How do you juice your investment returns? How do you get leverage without having to go to a bank and borrow a ton of money at high interest rates? For Buffett, the answer was hiding in plain sight. The magic word is float. Insurance float. It's pretty simple when you break it down. You pay your car insurance premium today, right? But you might not get in an accident for years, maybe never. In the meantime, the insurance company gets to hold onto your money. That's the float. And they can invest it for their own profit. It's basically a giant pool of money that they get to use. And here's where the genius of the Berkshire model really shines. They collect all these premiums. They invest that massive float into those great businesses with wide moats. And here's the unbelievable part. If they're good at writing insurance, they actually collect more in premiums than they pay out in claims. This means they are literally getting paid to use this money. It's better than an interest-free loan. It's a loan where the lender pays you. And the sheer scale of this is just mind-blowing. The float grew from about $19 million in the late 60s to over $176 billion today. This wasn't just some side hustle. This was the absolute core engine that provided the massive, low-cost leverage that turbocharged everything else. For the longest time, everyone just assumed Buffett's success was some kind of unexplainable magic. He was just the oracle. But recently, a bunch of academics pulled back the curtain and discovered that, well, there's actually a formula behind his outperformance, his alpha. A huge study basically reverse engineered Buffett's brain. And what they found was that his magic really comes down to a consistent, systematic focus on three types of stocks. Cheap ones, what they call the value factor, really high quality, stable, profitable ones, the quality factor, and safe, boring, low volatility ones, the low risk factor. The crazy part? Buffett was doing all of this decades before the academics even had names for it. So there it is, the recipe. You take these core ingredients, high quality, safe, and cheap stocks, and then you use the insurance float engine to add a steady stream of cheap leverage, about $1.6 for every one of their own. You mix it all together, and that's how you get Buffett's alpha. It's not magic, it's a formula. But, and this is a really big but, this incredible, perfectly designed success story has led directly to its biggest problem yet: the cold, hard, inescapable law of large numbers. And you don't have to take my word for it. Buffett himself is completely upfront about it. In a recent letter to shareholders, he basically said, yeah, those incredible days are over. Why? Size did us in. The machine just got too big. It's a victim of its own success. So why does size matter so much? Well, Berkshire is sitting on a mountain of cash. We're talking nearly $400 billion. Finding a great little company to buy for, say, $10 billion is awesome, but for Berkshire, it barely moves the needle. To make a real impact, as Buffett says, they have to hunt for elephants. And the problem is, there just aren't that many elephants out there, and most of them aren't for sale at a reasonable price. And that leaves us with this final massive question. The architecture that built this financial cathedral, from cigar butts to moats, all supercharged by float, it was absolutely perfect for its time. But as the company moves into a new era, at a scale that is almost unimaginable, you have to wonder, can those same old blueprints possibly keep working? Or does a structure this colossal need a completely new design to keep on building?